Most people think money reacts to the news, to the headline. It doesn't. Money moves first, and by the time you feel it, it's already too late because when pressure builds inside the system, capital doesn't wait. It repositions. And most people don't see this happening. They feel it later in prices, in markets, in opportunities they miss. So here's what most people miss. Money doesn't react to headlines. It moves before the headlines. In the last episode, we broke down $39 trillion in debt creates pressure inside the system. Today, we're going deeper. Not that money moves, but where it goes and how it gets there. Because money doesn't move randomly. It moves through a system with layers. Decisions on the top, channels in the middle, outcomes at the bottom. And if you understand that flow, you stop reacting and start anticipating. That's what this episode is about. Not noise, not headlines. Flow, direction, and where money moves next. So let's start with pressure, because pressure is what drives movement. You have rising debt, you have rising interest costs, you have global instability, and most people think about things like money supply or even the velocity of money, how fast money's moving. But what matters here isn't just speed, it's direction, where it's going, and why. Because when pressure builds inside the system, capital does not stay still. It looks for position. It looks for protection. It's looking for advantage. Now think about this. When governments carry massive debt, they don't stop spending. They redirect it, they prioritize it, and as debt rises, interest costs rise with it. That means more pressure on the system, more pressure on budgets, more pressure on priorities. $39 trillion. Let's pause on that, because that number is not just a headline. It's not just politics. It's not just background noise. That number creates pressure inside the system. It forces trade-offs. It forces priorities. It forces choices about where money goes and where money is not going. So you can literally watch that number rising. And that's the point. This is not static. That's the pressure still building. And once pressure reaches this level, every future dollar matters more. Where it is spent, what gets protected, what gets funded, what gets delayed, what gets left behind, and how debt pressure becomes capital flow. Not all at once, not loudly, but deliberately. And that's why every dollar spent becomes a signal about priorities, a signal about direction, a signal about where money is being pushed next. So money does not disappear, it flows from one part of the system to another. And if you can read that flow early, you can begin to see where capital is going before it becomes obvious to everyone else. Now let's get specific, because this is where most people stay surface level. When uncertainty rises, energy becomes critical. And the data shows why. In the first half of 2025, about 20.9 million barrels per day moved through the Strait of Hormuz. This is about 20% of global petroleum liquid consumption. And the EIA is clear: when major choke points are disrupted, oil and natural gas prices can move quickly. Money flows into production, infrastructure, security of supply, and this is where the system tightens first, because energy is not just another sector. It is the operating base of the system, and when that base tightens, capital starts repricing around it. And you can see it in the market's reaction. When the Iran war escalated, the WTI jumped 11% in a single day to $111.54. And this is not a small move. This is the market repricing energy risk in real time. And that is the takeaway. When uncertainty rises, energy risk reprice fast, because so much of the system depends on concentrated flow through narrow corridors. When currency weakens, capital looks for stability, not because of fear, but because of preservation. Money doesn't panic. It protects itself. It starts looking for places where value can hold. Even when confidence shifts, this is where capital starts separating risks from durability. And that distinction matters when pressure builds. Now, this is where things get interesting, because not all safe assets behave the way people expect. Gold is supposed to rise during conflict, and that's what most people believe. But markets do not move on one variable. They move through a system, and in that system, the dollar matters, yield matters, liquidity matters. In March, gold was headed for its worst month since 2008, down about 11.8% for the month. And Reuters tied that move to inflation fears, higher rate expectations, and a firmer dollar. Then on April 1st, gold turned higher again as the dollar softened. So the point is not that gold stops mattering, that gold still has to trade inside the system shaped by yield, the dollar, and liquidity. And when liquidity gets tighter, money does not always move into safety first. Sometimes it moves into yield, sometimes it moves into cash, and sometimes it sells what is liquid before it buys what feels safe. And this is why this section matters, because real assets still matter, but context matters as well. So now, take that one step farther. If energy flows are disrupted and dollar inflows slow, countries still need liquidity. And sometimes that liquidity comes from selling reserves. At the same time, not all transactions are happening in dollars anymore. Some are being settled in alternative currencies, not replacing the dollar, but shifting at the margin. And even small shifts change the direction of capital flows. Now, let's simplify the system, because this is how it moves upstream, policy decisions, capital allocations, and this is where direction is set. Midstream, you have contracts, you have corporations, supply chains, and this is where money is deployed. Downstream, markets, assets prices, wealth creation, and this is where outcomes show up. Most people only see the downstream, price charts, headlines, but the real story starts upstream and flows through the system where it shows up in the market. Now bring this back, because this is where most people disconnect. This is not abstract. This is not theoretical. Money moves first, and your life feels it later in prices, in borrowing costs, in opportunities available to you or not. And the difference between most people and those who stay ahead is simple. One group reacts and the other watches the flow. By the time the change is obvious, capital is already moved. So if you can see the money and where it's going, you can position yourself before it arrives. This doesn't start here. The pressure that moves money starts somewhere else. And if you don't understand that, you're always reacting too late. So go watch the choke point episode, because that's where the system begins to tighten before money starts moving. If this gave you clarity, subscribe, give me a thumbs up, because most people watch the headlines. We follow the money.